Hi, good morning, everyone. Thanks for attending the session today. I have great speakers with me to shed light upon some of the updates the last year that have come through on blended finance and specifically how it can help attract capital towards decarbonizing in India. So before we get started, I'm going to give a quick sort of overview as to where we were last year when we spoke, when I spoke at the same session last year on COP29. And since then, not much has changed on the financing demands. We still have $1 trillion financing gap. There is still significant amounts of funding that is required to finance the climate transition. COP30, there's not really been much movement in that sense. We still, the larger picture is still that, tax and government revenues is not going to be sufficient to fill that gap. We are going to be relying heavily on private sector and funds to kind of fill that space and finance this. Now, the other thing to keep in mind is, based on the work we have been doing with Niti Aayog, for instance, is that a lot of this financing, when we look at $1 trillion, bulk of it is still required. I would say 50% approximately is still required, possibly in the renewable space and financing the energy transition. And that's something which is more infra-focused, more in terms of technologies that are already scalable, that are already viable and commercial, where the real problem to solve for is lowering the cost of capital so that you're able to attract more voluminous funds. There's the other part of the financing spectrum where we actually need money towards high risk and innovative technologies, which is where more blended finance is going to be required. Now, keeping this in mind, I think regulators, the few sort of trends that we have seen the last year in terms of regulatory action is that there's been a huge uptick, and I'm not speaking just about funds-focused regulators. To give you a broader view, we've had the Reserve Bank of India, for instance, release many papers also focusing on integration of carbon metrics and tracking within the financing and greening the banking system. This is all driven by, and we've had the Ministry of Finance also release a broad framework for climate taxonomy. This is all driven by the perspective, for instance, that RBI is increasingly concerned about macroeconomic effects of climate activities, climate impacts, particularly on inflation of food items, etc. We've also had SEBI and IFSC come up with consultation papers, and they've changed the regulation to permit certain structures which were creating pain points. For instance, SEBI has allowed senior junior structures if a state government or government institutions are involved, therefore allowing blending of capital within a fund. IFSC has also recently come out with a paper, consultation paper, allowing the same, and they've given certain limits and thresholds and conditions, which we will get into in a little bit. But keeping all of this in mind, I think there has been some regulatory uptick, and on the demand side, nothing has changed. On the demand side, actually, when you look at state governments as well, for state level financing plans, we have the FRBM Act, which also says they cannot borrow more than 2% of their GDP, for instance. So when they're looking at different sources of financing climate transition, you would have seen the Bihar Climate Fund recently being announced, for example, as a mechanism that states are increasingly looking to turn to, right? And with the regulatory changes, I think there could be opportunities or challenges there. So with this sort of a broad, the layout, I would turn to, I think, each of the panelists to maybe spend a few minutes to comment upon what are the opportunities they see, what are the trends that they see, any sort of barriers, challenges, that they would like to comment upon, and then probably go back for a second round of specific questions. I think the one other thing to keep in mind is, of course, the US position on climate has fundamentally changed in the last year, and which means that, fund flows are shifting away from the traditional jurisdictions, and we are seeing money coming in from different parts of the world. So, but I leave it to our panelists to kind of comment on some of these aspects, and with that, I'll ask Akshay to maybe come in first, and each of you to take a turn after that.
Thanks, Mayor, and good morning, everyone. Great to be here at the IVCA Green Return Summit this year as well, and thank you to IVCA for putting this together. I think very interesting perspective that Mayor brought in on blended finance and whether it is relevant in some subsectors of the climate spectrum and not so relevant in other subsectors of the climate spectrum. If you look at renewable energy generation, I think that been tested and proven as far as commercial as it can be, and therefore the requirement for blended finance or a financial intervention in the nature of a blended finance is significantly lower compared to newer and more emerging sectors, be it water, be it agriculture, be it anything to do with innovation, which still has a fairly long gestation period to go to make it proven to commercial viability. I think from that perspective, yes, blended finance is very important as a tool to catalyze more capital, more commercial capital coming in. But I think we need to clearly articulate the use case for this blended finance to see where it is going, whether it is going into a solar or a wind project, or is it actually going into perhaps a tech-driven, innovation-driven water and sanitation business, which perhaps is far more longer in its gestation period to yield commercial returns. I'll just pause here. Aparna.
Good afternoon, everyone, and thank you, IVCA, for this opportunity. I think maybe just to pick up, Akshay, from where you left off, I think our perspective on this is looking at it slightly differently now. While with allowing, say, state governments to have two different classes, as you mentioned, is definitely a step in the right direction. I think the fundamental issue that we see would continues to be that of risk perception. So I think that is still an area that blended finance continues to will continue to need to solve for, because with certain state coffers being in the position that there are, for investors to really come into these funds as well, you might require certain risk-sharing mechanisms where either philanthropic capital or, say, federal capital might still be required from a risk mitigation perspective. So I'm thinking right now of the Tamil Nadu pooled fund as a good example, where different municipalities came together to raise larger sums of capital. Now that's obviously been done almost a decade ago, but continues to be a good example as to how state funds were used and also different risk sharing mechanisms were in place. So I still see a very strong role for blended finance, while from a regulatory perspective, as the previous panel was also talking, I think we are taking steps in the right direction. I think second, as Akshay also mentioned, a very important point, just mapping out different subsectors where capital can flow. Now, obviously, with, say, wind and solar starting to be, have more stable businesses, and I would say from an LP perspective, they're seeing a lot of, stable returns in this perspective, in these subsectors. The question really becomes, is there a need for blended capital to really come in, or is this an area where commercial capital can already see sort of business models at play, and then is this something that really requires subsidization of returns or any sort of risk mitigation, right? So in our mind, I think there are certain areas, for example, adaptation and all, that are not getting funding today, and that might be sort of better use cases when it comes to use of blended capital or even subsidizing returns in some perspective. To a point, I mean, this is not going to happen in eternity, but to a point where business models are more established, or at least pathways to monetization are more, more established for commercial capital to then start coming in. So we're not talking about subsidization or sort of risk mitigation to eternity, but certain sunset clauses do need to be put into place. So you're judiciously using public sources as well as philanthropic sources. So I think in summary, I think steps in the right direction from a regulatory perspective, but I think a clear mapping of subsectors and potentially areas where states are coming into their own, starting to use blended capital a little bit better, where we might still see the need for blended finance to still play a role. But I'll pass it on to Satya.
See, blended finance, in my view, can be looked at in two different perspectives. One is proving the innovation to a point that the market believes in it. And that is what I call the gap between POC to POV. In innovation terms, it could be from TRL 6 to TRL 8 or 9. That's where I think the equity capital comes at a very, very difficult terms. A blended finance can play a very catalytic role if we are able to bring in early. So this is sort of a softer equity, or you can call it softer debt, whatever way, but I think somewhere it fits into more of non-dilutive capital or dilution at a very different terms. The second stage of blended finance, which in my view is required when you are already proven, where the POV is proven, proof of value is proven, it's beyond doubt that it works, and its unit economics are scalable, but you need to now scale up that business to a level that it can really make a meaningful impact. That's where we have seen a significant adoption already in certain sectors like renewables, but in many other industries which, I mean, are still at a very early stage of getting scaled up. So I believe that for an innovation to be impactful, it has to be not only viable, but also be scalable. So I believe this is a combination of some amount of viability gap funding, which comes to the point of POV. And the second stage is where we basically take a proven solution to a level of scalability. And this has got different dimensions of capital. Maybe we can touch upon that later. Thank you.
Hi. Thanks, Satya, for delineating those areas. So we have worked on quite a few. So from proof of viability to scalability, we have a guarantee facility where we have provided capital to SIDBI for a guarantee to circular economy companies. This started, I think, in 2022. And that guarantee facility has currently enabled around 35 crores of debt. Now, and 2022, circular economy was a buzzword rather than a business proposition. Currently, I'm quite proud to say that some of the people who had used the guarantee have actually repaid the debt, because the guarantee has enabled them to showcase themselves to bankers who have then got it at better terms. So this has been one journey. The other is, you were talking of proof of concept to proof of viability. So we built on a program called Lakpati Kisan, which increased income of farmers from, say, INR 30,000 to 1,20,000 in a year in very remote areas. And there were many factors which enabled this, but the big factor was collectivization and use of certain technologies. Now, these are very, very new technologies, sometimes old technologies, but repackaged for very rural and distant areas. So for investors to do a consumer financing needed a lot of effort, where our money, which is public money, has gone in, which is now has led to debt. Some FIs are looking at equity. And in time, the manufacturer will look at equity and debt, which hopefully maybe Series A will need some support in transaction costs, because it could be that 30% of the transaction costs are 30 to 40% of the whole deal size. That makes it very difficult for anybody to foot it. So this is the entire spectrum we are working on. And hopefully there are lots of technologies, including the ones exhibited here. I had a very quick look at the exhibition, who are at that POC to POV. That is where this kind of stuff works. And hopefully there's a lot more to do. Thank you.
Thank you to IVCA for having us here. So I think to summarize a little bit of what we've heard on the stage so far, there's a wide variety of uses for blended capital. And they really can come anywhere from as early as proving innovations all the way up to like validating new programs for insurance to make technologies and our future economy more resilient. And I think that how that ends up being very different, whether or not we are looking at early stage technologies or late stage technologies. But I think if I were to pull a few themes through, what we always see is that there is either an excess real risk or an excess perceived risk. and that is what the concessional capital is meant to address. So in the case of a technical assistance facility, that very much is covering a real risk of how do you get this to integrate, whereas there's also, and we've seen, for example, within the early days of solar in India, that was very much addressing perceived risk. Will solar panels work the same way in India over the long duration? And we see that trend across a variety of instruments. But what we really need to remember as we think about transitioning from the current economy to the future economy is that there's a lot of financial tools and instruments that are not functioning necessarily well in the climate space because there's different perceptions of risk for physical asset products, for assets that integrate into industry or energy, versus what venture capital and private equity prefer to fund, or what banks who like to have a zero risk instrument prefer to fund. And so it's really about trying to address that. And then just to kind of make it a little bit more tangible, at Green Artha we have 2 initiatives where we've used blended capital. The first was we piloted a results-based climate finance program where NGOs and startups were able to secure funding through foundations and corporates for delivering results within communities that were related to a set number of metrics. And we very much saw that as that was very much I think, a lead into what could now be the green credit scheme, and which is much more approachable for small businesses and small farmers because it's not dependent on a very expensive certification system. Separately, we were just certified at COP30 for the Global Climate Finance Lab for our work on early commercialization with startups in the industrial decarbonization space, where we both provide blended capital within our financial structure to bring capital into the most significant capital gap, but we also provide very detailed hand-on technical assistance to help startups that are ready to start integrating with industry to be able to do that and to build their first factories so that they're able to scale and become investable by the larger market. Thank you.
Thanks everyone for your opening remarks. I think just want to dig in a little bit into a couple of questions and the remaining time we have. First one is, where do we see the money coming from? Because with the US sort of changing its entire track on climate financing, I think there has been a shift in capital flows. Would be good if Akshay and Satya could probably share their experience on where do they see this coming from, has it been changed, and where do they see the future going?
Thanks, Mia. So yes, given that there's been a bit of a slowdown in the US climate financing track, and that's most definitely there. We are seeing, at least from our experience, we're seeing pockets of capital being available in Europe and in Japan. We're seeing a lot of Japanese interest in the climate space that's been picking up over the past 12 to 18 months or so. Europe definitely has always been a leader in the climate financing space. There is obviously some internal constraints that they have, but I think they are still looking at climate financing as a fairly active piece in their portfolio allocation.
See, first and foremost, we must realize that the need has not gone away. Some players might have stepped up their paddle or might have slowed down. But I think the belief overall in the global ecosystem, particularly in the large family offices and the philanthropic capital for climate sustainability solution, and more so with regard to supporting the innovation to make it really impactful and scalable, I think that pool of capital still stays. We need to now create more and more successful case studies to attract this capital. So let's dissect the need into 2 parts. One, where we are proving the innovation from POC to POV or TRL 5.6 to TRL 8.9. There could be different pool of innovation capital which can be brought in, and some of this could be in the nature of blended finance. When it comes to building the scale where the unit economics are already proven, I think this is more of a commercial capital available at a shorter terms because this has got a profit and purpose together. So I think we have to dissect these two pools of capital, and we have to target wherever there is a, I would say, profit and purpose coming together.
Yeah, please go ahead.
Yeah, just one more point. I think there's a lot of domestic money also that's now coming into funds, whether you call them blended finance or whether you call them slightly longer term gestation capital. I think we're seeing a lot of catalytic capital coming in from domestic LPs, be it the government's own push through various mechanisms, policy interventions, or be it private capital. I think domestic capital in India is also picking up fairly rapidly.
Yeah, thanks Akshay and thanks Satya. So I think to reiterate, that's what we also note, which is increasingly Japan and other investors are stepping in to try and fill that gap. The demand side has definitely not changed since we spoke last year, which is what the studies show. And I think one interesting thing, as you rightly said, even in the movements that we see, you made a point earlier about viability and scalability, right? And I do think family offices are increasingly stepping in where it's even just viable, may not necessarily scalable, and that's something for private capital to pick up afterwards. Coming to other sources of capital, since we are speaking about blended finance, it's also important to understand where is the catalytic capital coming from, which includes philanthropic sources. It could be CSR, it could be money from foreign philanthropies, or there is another pool of capital which, in terms of the underutilized retail money that is sitting around today, right, which is increasingly going to mutual funds. So just wanted to check if, Aparna, you had any sort of views on the philanthropic capital, on the trends, and Akshay, another panelist, on the other sources of capital and whether it's easy to unlock that.
Yeah, thanks for that, Mia. I think in terms of the stakeholders, you've sort of listed that out, right? So in addition to what Akshay and Satya already mentioned, we're definitely seeing, especially in the aftermath, if I can call it, of what's happened in the last 12 months with the US. Definitely a lot of family offices in Europe, HNIs in the US as well, who are now definitely looking for returns, but want to put their capital to good use. So they're taking a portfolio approach to investments where they are saying, okay, fine, we have obviously parked some of our funds, which are more sort of public markets, returning their investments with certain return expectations. But also then are willing to put some of that money into, or at least a portfolio approach. So that means they're parking some funds into more sort of greener avenues, right? So sending money into India to see if it can, go into projects where they're, at least earning what they call muted returns, but at least capital preservation is something that they are looking at the very least. So that's sort of one bucket that we're seeing. The other, of course, is CSR funds that are now starting, at least in the Indian context, starting to step up and say, okay, fine, how do we put our money to better use? How do we make it more catalytic? Global foundations have definitely been playing that role, and we continue to see that happening. In fact, I would say some of them have, taken some time to sort of step back, recalibrate, their sort of strategy as well to see where is it that they need to now step in. Just given the way things have moved with the US. So we are seeing a lot of the global foundations now embed climate more deeply. So it's not just an add-on, but actually strategically becoming, a part of their strategy, whatever sector is it that they've traditionally been working on. So even if it's livelihoods, trying to see how do you integrate, that with climate. So definitely seeing a lot of that. Mia, if I can add one point to your previous question, maybe just building on what Satya said as well. I think there is capital. I think something that is keeping it from being adequately used. There's two parts to that, right? One, people talk about pipeline a lot. So where is that pipeline? Because at the COP, you're starting to, not starting, but in the last couple of years, you've seen that large funds are being announced, but where the rubber meets the road is, okay, how do you really deploy that capital? Where is the pipeline? Is it really meeting the investment needs, both from a financial returns perspective and an impact perspective? Now, on the returns perspective, that might be the case in certain sectors, but the impact angle here is really important as well, right? So Can there be convergence on how people are looking at reporting of impact in the climate space? Now, countries have taxonomies. There are some global movements towards that as well, but there needs to be convergence. We need to be speaking the same language so that it's also easier on companies when they're looking to raise green funds or climate tagged funds on what is it that they should be reporting, how is it that they should be reporting, because we've seen really long timelines and often sometimes deals not converting because the investor and say the company that's raising money are not able to kind of bridge that gap. Even on some of the projects that we're working on with the World Bank, now that's not really on the supporting climate startups. It's more sort of farmer-producer organization-centric. How do you get more access to financing which is tied to meeting certain climate goals? But there, we're solving for some of this, jointly with the World Bank and the UNDP who's supporting the project. So I think that this is one piece where we feel a lot of work needs to happen. We've started to kind of, again, make some progress there. There is a taxonomy that obviously NABARD and CPI have put out, but does everyone really understand that? That's more of a framework. How do you actually make it more usable? How do you, set certain examples for people to start using that better? So I think from a practical perspective, there's a little bit of work that needs to be done on that front as well.
Yeah, thanks, Aparna. And on that related point, actually, there were two things I wanted to cover and get the panelists' view. One was, where is it? So we have these pools of capital, philanthropic, foreign, private capital. One of the questions I do want to touch upon is, where is it easy to pool them? Where is it easy to blend them and deploy? But before we get into that, we already got into the discussion on pipeline, because even if capital is there and if regulations are paving the way for it, I think we can address the pipeline question since you brought that up. And I was hoping that Sandeep can probably comment upon the role of technical assistance grants and, whether they can help sort of strengthen the pipeline, and if he has any sort of perspectives on that.
Thank you, Maya. So I gave some examples of how our technical assistance worked in looking at some technical solutions which increased farmer income. And then now we have some financial institutions starting to lend for that. We have 3 or 4 who have already done so, and there's a fairly long pipeline. So this is an example of commercial finance coming in, but the groundwork to enable the policy decision within the financial institution has been enabled by public money, which is our money. These are some of the examples, and there are other examples of CPI running a fund where they're enabling transaction costs, like making a strategy document or paying the lawyer fee for a transaction where the startup is too small to afford a high cost of such costs, because the technology can be complicated and the deal size might be small, but the deal structure might not be the most straightforward, where the transaction costs can therefore be very high. These are some of the areas where we have been playing a part and will continue to do so. Of course, our projects are very sharply delineated in terms of sectors and areas where we can work, so it will have that limitation. In terms of the kind of capital, people like us or the global philanthropies are a little bit more hands-on than the Indian counterparts here. But the trend is surely that the Indian counterparts are developing and will step up their game. Thanks.
Thanks, Sandeep. So just sticking to that question on pipeline once again, I think now, based on the earlier discussions in the panel, we know that the regulations have opened up, state governments can participate as LPs, even contributing their capital as first loss, invest in such units. And there are, Tamil Nadu Climate Fund has been set up. Bihar has announced a state climate fund. But typically the requirements for these funds is that then the money has to be invested in startups or companies that are based in those states. So just wanted to quickly check with Akshay and Satya, in terms of pipeline, do you think that's realistic? Is it possible? What challenges do you foresee? Or, is there a better way to go about this?
Just checking if it's audible. From a pipeline perspective, I don't think it's too much of a challenge. Speaking from experience in Neev, in our second fund, we've invested across a fairly diverse spectrum of climate technologies. We've invested in circular economy, we've invested in green hydrogen, we've invested in pollution control device manufacturing, we've invested in battery technology, sustainable agriculture, energy efficiency, and water and sanitation. So I think we've covered a fairly broad spectrum of subsectors. To answer your point on whether state-specific pools of capital are available and whether that presents a challenge for pipeline, I really don't think so. I think that's not a challenge at all. Given the speed at which today's innovation is happening across the country and the opportunities that are coming up by entrepreneurs across, I don't think that's going to be a challenge at all.
See, I think this is a good initiative that at least the state governments are coming forward to bring the catalytic capital play. However, we need to think about the timeline and the way that the deployment can be accelerated. And here I would like to give the example of our old version of DFI. I mean, some of you who are who were there in the market in the 90s, we used to have these DFIs, IDBIs, ICICIs of the world. Now they are all turned into bank, and after that they have lost the character of DFI. But in those days, anybody with a viable project could walk in with almost like 1/3 of the equity, and 2/3 will be financed by the DFIs. And the DFIs used to also have an additional clause to it that certain part of the equity, if they like, they can convert certain part of the debt, they could convert into equity. So they were taking a little bit higher risk, but at the same time, they were also trying to sweeten the rewards by way of sweat equity, or some kind of warrants, which is nowadays you see in the venture debt kind of a structure. And the projects were getting significantly, many of the industries today you see around in India were financed in the olden days under this venture debt structure, the typical DFI venture debt structure. I think the time has come that now, at least for a scalable business models, I'm not commenting on renewables because that is already to a large extent supported by a different institutional infrastructure, including DFIs in the form of Power Finance Corporation, IREDA, and many other companies. But I think we need to bring a similar infrastructures of DFIs or DFI-like institutions supported by global capital as well as the local capital, where we can scale up these project finance, or you can say the scale-up finance on a proven unit economics model. And earlier we can intervene, the better it is, because you can do a faster adoption and acceleration as well.
Thanks, Satya. Stalin, would you like to?
Yes. So just to discuss the specifics of the states, since the states do have this mandate where they want the capital to stay within the state, I think it's important to realize that that's something very difficult to do within a venture AIF structure. It's also very difficult because an AIF cannot say, we're only going to invest in this state, because that tramples their fiduciary duty to their other investors, unless that's what their original mandate is. But I think that when you look at that, there's a very interesting opportunity for the states to be able to partner with venture funds or other technology providers, such that when there is a certain level of maturity reached, the states can use their discounted funds for things like setting up factories and establishing the infrastructure that will actually bring jobs to their area, even if it's a startup from a different state. And that can then also work with the IVCA, or the IFRS and SEBI guidelines around how funds can be blended or side-pocketed within a AIF.
Yeah, Sandeep?
I second Starlene's issue about being specific on the geography. The technology is new, potential user sets are all over the country. Who will bite first needs taking a lot of hard knocks, and it's extremely difficult to predict which geography who will bite first. So this geographical limitation can be a really severe drawback, especially if you're expecting that something physical turns out in that geography. So just for example, I'll take an example. We started with financing of drip irrigation. It started in Ahmednagar, where the awareness was relatively higher. We now have another FI looking at 5 districts in Uttar Pradesh, which came a bit later, but we built on that story in Ahmednagar. And then now we are thinking of going to a relatively backward area with some kind of a support. We are saying to some FIs, look, we'll get the credit scoring of all your counterparties done at our cost. That will give you an idea within the disadvantaged geography, who would you want to start with? And hopefully then 3-4 FIs come, and then the risk appetite increases, and then it goes down. But the geography being specific is, when there are so many variables and so many things can go wrong, is a major drawback. Thank you.
Thanks, Sandeep. So I think last question we'll be quickly trying to cover is, we've heard from the panelists what kind of capital is available today. And we've seen what the more recent regulatory changes that have come about, either in IFSC or in terms of mainland, where SEBI has permitted more senior-junior structures. But even with all of this in mind and keeping the tax regime, I think one question that comes to my mind is it easier to still blend different pools of capital in India, outside India, in GIFT City? What is the preference? Because I think the topic of the panel is to drive money, blend it, and drive it towards decarbonization investment. So Satya, perhaps you'd like to kick us off on that one.
Yeah. This is my 2 cents, and please ignore if you don't like it. I have been following this formula of 1:2:7. And this is a dream state, if it can work. What does it mean? That we need to bring in about 1/3 of equity and roughly about 2/3 of debt. The debt can come from any local or global institutions, which can ride on this 1/3 of equity. That's the reason 1:2:7. And why this is important? Because the debt is riding on the catalytic capital coming in the form of equity. And this 1/3 equity again has to be divided 1/3 by private sector and 2/3 by any institutional or a government sector. Because government sector will say that we need a private lead. So for every $1 or every 1 rupee of private capital, we are practically getting 2 rupee of institutional equity capital, again in the form of catalytic form, and another 7 in the form of catalytic, in the form of impact debt. So this format, if we can adopt it in a little more institutional framework, in whatever combination that we can all think of it, I think we'll get a significant blended finance raised, make the projects far more scalable, and accelerate the journey of adoption.
Thanks, Satya. Starleen?
So what we have experienced with raising blended capital is that it depends on who the investors are. Some investors are very open to India. The ones that are generally also open to it just coming into an Indian AIF. They don't have a strong preference for GIFT. But we also have come across a number of investors who are very insistent that it not be an India-based or GIFT City-based fund. But I think, and this is a little bit into reference to one of the earlier questions, the 2 things that I would say as we see in the market is that there has been a significant contraction, and there's 2 factors that are coming out of that. One is there's an increased requirement that if you're receiving blended capital or concessional capital, you have to treat that with the same or higher fiduciary responsibility. And fundamentally, they still want to see the commercial investors get a commercial return because that means they are needed less. But you also have the fiduciary responsibility if you're taking concessional capital to additionally provide that proof that the risk, real or perceived, has been reduced. So I think that that's one thing that we've seen. We have also seen as kind of the second factor to the reduction in concessional capital availability, being that there is a much more significant need to start looking at how do you move from having blended capital to not having blended capital or any sort of concessionality as part of your business plan. And we fundamentally operate off of the belief that if you're able to reduce the risk, which you should fundamentally be able to do in very short periods of time, there should be a really significant move to reduce the amounts of blended capital in specific instruments or specific fields so that that capital frees up for newer or more nascent stages.
Thanks, Darlene. Aparna, closing comments?
Yeah, I think very quickly, I mean, it's not straightforward to say this or that, right? I think like in most situations. So I think depending on where the capital is coming on, what the end uses are, I think there are thankfully now blueprints that exist for different things thanks to some of the good work that, say, Maya, you've been doing or Tri-Legal has been doing as well. Is to say, I mean, we've seen situations where a pooling facility outside India makes more sense now with the Gift City coming in, obviously avenues are opening up here. In specific instances, we've seen that, just even bilateral arrangements probably just work more efficiently than trying to set up complex structures and, there's cost and time involved with that as well. So I think it's really sort of situation dependent. We've had arrangements where we've gotten a philanthropic guarantor who's a European, guarantor come in and provide guarantee capital to NBFCs here as well. And that was just a bilateral arrangement that worked beautifully. We've done a pooling structure outside. We're now, exploring options in Gift City. So I think the short answer, it sort of depends on where the money is coming from, what the end users are. And I think based on that, sort of taking the best path forward.
Thanks, Aparna. So thanks, everyone. I think we're at the end of our panel. So the closing, takeaway is that on even though there is regulatory support and there are increasingly, regulators are acting on the requests from the private sector and making blended finance more easier. I think typically the more different types of capital you try to blend, whether it's guarantees or philanthropic, I do think on balance, in many cases, it may end up being easier offshore, just speaking as a lawyer, and better tax support. But I think the future looks bright. A lot of the discussions with the government that we are having, I can tell you that they are aware of some of these problems and are actively trying to solve for it. So hopefully it'll make it easier to do this directly in India and not have to figure out which is the best place on a case-by-case basis. And with that, thank you everyone for your time and for your views. Thank you everyone.
A big thank you to all the panelists for that sharply focused discussion. I request all of you to please come together for a group photograph. I think that session gave us tremendous clarity on how India can actually mobilize capital at scale for its climate transition. A big thank you to all the speakers today.